Hello, Bay Area. Welcome to Real Estate Insights, where we break down the trends and factors shaping today's housing market. I'm your host, Nagaraj Anaya, and in this episode, we are diving into a topic that's making news: falling mortgage rates. On the surface, lower rates might seem like a dream come true for home buyers, but there is more to the story. As the saying goes, be careful what you wish for. This summer, lower mortgage rates have stirred up a real estate activity, with many wondering if California's 2 year home buying slump might be ending. The Federal Reserve's fight against inflation, marked by higher interest rates, made it tough for many to buy homes in California, correct? But now, as we move into the middle of 2024, the cost of living is moderating and overall economy is slowing down, which has already brought a mortgage down from the recent peaks. And with the Fed expected to cut its benchmark rates in September, we might see rate drops even further. Last week I was mentioning you like the rates currently in the Bay Area are like currently is 5.8 to 6%, and it depends on various circumstances, right? But the minimum is for arm rates of 5.8% APRs. Okay, but lower rates do help ease some of California's notorious affordability issues. Some experts even suggest this could spark a buying spree, pushing prices even higher. But before we get carried away, it's important to recognize that lower mortgage rates often signal economic trouble. Remember, rates typically fall when the economy is cooling. So, let me give you a couple of examples in the Millipitas what happened. I had put an offer around close to July mid. This house was listed like for a 2.4 million, and this is like 2000 square footage home, great neighborhood in Milpitas. It was listed for 2.4 and it was already listed 150K above the market value. But that house, you don't believe it, sold for 2.61 million, and that was received the 13 offers. But the same this week's in the same, and that house was sold, and the same thing in the same neighborhood, same square footage, maybe 1,000 square footage on the lot front. Another house was listed, and that was listed for close to 2.5 now. So 100K above the previous list price. Do you know how many offers they got? They got five offers yesterday, and they were able to sell it for more than 2.65. Number of offers went down, but it's still the price is like got a higher price. Correct. Now let's dig into the numbers. Okay, whatever I'm talking about, let's dig into the numbers. I've been looking at a data stretching back to 1977, including average 30-year mortgage rates, California home prices, and the state's unemployment rate. What I found is pretty revealing, When mortgage rates went up over a year, California home prices rose by an average of 10%. That's a 10%. But when rates fell, home prices only increased by 4% on the average. This might seem like counterintuitive, right? But let's look at what this means for a buyer. When both home prices and rates rise, the average house payment jumps by 21%. It's a big hit to the wallet, but yet buyers seem willing to pay. On the other end, when the rates drop, the average house payment only decreases by 2.6%. That's what I was telling you, right? Like from 6.25 to a 6% when it drops, it hardly it is like 250 to $300. So while cheaper money makes home more affordable, the overall benefit is not as large as you might expect. This is what I'm noticing. And this pattern starts to make more sense when we consider the broader economy. Over the past 47 years, when mortgage rates went up, California's unemployment rate typically dropped by a zero point 0.7 percentage points. That's because rising rates often accompany a stronger economy where businesses are hiring, correct? But when prices fall, unemployment tends to rise, increasing by about zero point 0.3 percentage points on an average. This is a sign of a weakening economy, less demand, and a Fed that's stepping in to help. Now, what's this takeaway all about? So, what's the takeaway now is all about? When it comes to real estate, it's all about jobs. Over the past 47 years, when an unemployment rose, California home prices gained just 2% on average. But when unemployment fell, prices jumped by 9%, Right now, California's unemployment rate has been like above 5% for the past 10 months after hitting a record low at 3.8% in August 2022. So while lower mortgage rates might make a buying a home seem more attractive, you need more than just a good rate. You need job security and confidence in the economy. That's what I was discussing with one of the comments which I received recently. It is like they were comparing to automotive industries long time back, but it's overall now the economy is right now is a different. As we head into a summer 2024, we could see a falling rates push some home prices higher. But the real question is whether the economy can manage a soft landing with a minimal job losses. Since 1977, when mortgage rates dropped in a year, California home prices rose just 67% of the time. Correct? Not bad odds, but still, when rates were rising, prices increased 85% of the time. The impact of falling mortgages rates can vary depending on how much they drop. For instance, when rates dropped by half a percentage point or more, home prices rose by an average of 3.6% over the next 12 months. But notice, unemployment also climbed nearly full percentage a point. So, as you consider your next move in the real estate market, remember that falling rates are not always the golden ticket they seem to be. The same thing happened yesterday. I was putting one offer for one of the townhouse in a Campbell. So that is why, remember that, like always, stay informed, plan wisely, and keep an eye on the job market. Thanks for joining me on Real Estate Insights. I'm your host Nagarajan Naya. Until next time, stay savvy in your home buying journey and do always keep encouraging. And if you have any comments, do leave your comments and let me share your viewpoint. Also, I'm happy to respond for it. Thank you so much.